Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch with me in Taoleng Lechela, and joining me to unpack your stock-related questions today are Jared Hoover from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag Stockwatch. Now, Victor's going to join us in a bit. He's just dealing with some technical gremlins. But for now, it's you and I, Jared. So let's get things on a roll, right? A question here, is the UK uninvestable? Really coming on the back of the UK autumn budget, where Chancellor Rachel Reeves, of course, raised taxes. What kind of impact would this have on consumer-facing SA-listed stocks that operate in the UK?
Yes, and I think that news did break very recently, and naturally you always have the knee-jerk reaction where a number of stocks would react pretty poorly to the news because they were increased, because it looked like it was an anti-growth, sort of anti-private sector type of budget, without kind of cuts to social welfare. But I think having said that, we really need to look at this from a more selective kind of process, because a lot of what was released was already known. I mean, some of these items were already leaked in the past. And I guess typically what you'll find is the first reaction will be to be short domestic earners and long offshore earners. But from our perspective, I think I'd rather highlight a few winners for you, and then maybe we'll highlight one of the losers from our read of it. And I mean, when we looked at the winners, we actually thought that the likes of Investec and FirstRand, I mean, two stocks that do have exposure to the UK, we actually thought that they performed relatively well, given the fact that the budget did not really appear to impose any fresh windfall taxes or any extra surcharges. So from that perspective, one of the winners we would have picked out. On top of that, on the wealth management side, Quilter, there wasn't any unchanged pension lump sum tax relief. On top of that, they have something called individual cash savings accounts. And the cash limit was actually implemented, which would be beneficial for stocks. So that would actually play into the hands of Quilter. And lastly, I mean, something to bring it closer to home, we do know that they increased the duties and the taxes on the online gaming sector. So think the likes of Flutter and Entain in the UK. That resulted, or looks like it was going to be, about a 10 to 20 percentage point increase in some of the duties levied there. So quite stark. But when we compare that to maybe South Africa, I mean, a paper was released by the SARB recently, and our rate was only about 20%. But the point is, I think it'll take a bit longer in South Africa, but our glide path over time, as online gaming becomes or moves from a more nascent kind of industry to more mature industry, probably tells you there will be incremental taxes that will be levied on the online gaming industry. Think the likes of a Sun International, Tsogo Sun, and even maybe Canal Plus eventually when they list on our bourse, given the exposure that they have via MultiChoice's Kingmakers business.
And that's a great segue into our next question, because it's on Tsogo Sun. Just your analysis on Tsogo Sun's latest results. Reasonable. The share price has also rallied. Is this a sign of a recovery, Jared? The viewer here saying, should I buy now, or will this stock just never see the 10 Rand and above again?
That's a fantastic question. I mean, when we looked at the results, we actually thought there were a number of positives to take from it, even though we are probably still neutral on the stock. And I think there's probably about 5 of them that we wanted to highlight. I think the first one is that management credibility. I think this is the first time in the recent past that the management team have delivered on the earnings that they have suggested they would produce. I think market expectations probably was for negative growth, but that came in flat, so better than expected. But the point is, management credibility is improving. That's a good thing. We also liked what we saw in the outlook statement. Qualitative in nature, yes, but it did speak about delivering market-leading earnings growth going forward. And that's obviously better than the rest of the hospitality sector, as well as strong cash generation. So given the fact that management, we can put a tick in the management credibility box, we think that from the outlook statement that is quite positive, we think we can start to believe some of that. The third point is on the buyback. I mean, the company did indicate that they are going to buy back another 30 million shares. That typically provides a bit of an underpin to the stock. We think that's positive. And we also think that maybe in the future, if HCI or Hoskin Consolidated had to unbundle some of their stake in the company, that would also be positive. And very lastly, I mean, once you overlay valuation, I mean, this stock is trading at about a 4 times forward PE. And if the expectation going into results was that earnings was going to go backwards into the future, then that PE would actually end up being more expensive than 4 times, in which case you probably wouldn't want to look at it. But if they deliver on what they said they stated in their outlook statement, then potentially that multiple becomes even cheaper, and this may be an entry point or one to consider going forward.
Looking at some of those deliverables, it does seem like Tsogo has a very tough balancing act, especially when it comes to investment opportunities in the online betting market, because that stake is still quite small when looking at the overall group. But on the other hand, the group also trying to reduce debt.
Yes. And I mean, when we looked at some of the stats on online gaming in the set of results, it did show some positive traction. Yes, it's off a low base and the numbers and the growth is relatively small. And there is a degree of catch up that they need to play relative to some of their peers.
Yes.
But we think that was incrementally positive. And the other thing we think about is that, I mean, obviously you've got the better operational performance from the group, but there's also some below the line benefits which would help cash generation going forward. I mean, lower interest rates and the like. And if that helps cash generation, then it allows them to reduce some of that debt going forward. And naturally, you get this enterprise value into equity value conversion, which is something we also need to think about, given how cheap this valuation screens.
Victor, maybe let's bring you in at this point. Just your thoughts around the players that are within the online betting space. You have the likes of a Tsogo Sun, you have the likes of a Sun International. Your view around that, especially at a time where we are seeing many regulators, many other businesses sounding the alarm on this industry. Jared just mentioned that we saw a white paper out of Treasury where they are looking at perhaps implementing a 20% tax on the industry.
Yeah, can you hear me now?
Yes, lovely.
Okay, awesome. My apologies, sorry, I had problems with my microphone. I think these players, traditional casino players, Tsogo Sun and the rest, are going to have to pull off a very good execution transition of their business from casino-based business, which has shrunk from being 80% of gaming revenue to now being in the region of 30 to 20%. The infrastructure cost will probably burden their business for some time to come if they do not cut costs and reduce the footprint that they have. So that will be the imperative for those businesses. I think the entry barriers into online betting are significantly lower than they are for the casino business. So I think it's going to be a lot more competitive business than the casino business was, and so profitability should be lower. As for government's 20% tax proposal on gaming, that's unlikely to change gaming behavior. It's just going to bring in more money for the fiscus, and the problem, unfortunately, will persist.
Let's just take a look at Cell C before we head to the break, and I'll stick with you, Victor. All eyes were on, the counter as it debuted on the JSE. Did you dip your fingers into that, or are you playing a wait-and-see game?
No, unfortunately, Cell C is one name that we will be avoiding.
Okay.
Unfortunately, it is for more than 20 years. Cell C has not made a free cash flow profit consistently, at least. So it's the number 4 player in a cell phone market that's becoming increasingly competitive, not only among the traditional players, Vodacom, MTN, and Telkom, but also among the MVNOs, who it aims to service and what it intends to be itself. The MVNOs are intensely competitive, from Capitec, sure, Pep will be in business, ShopRite. So competition on all fronts. And so I think it's going to be difficult for Cell C to achieve a reasonable level of profitability that will attract us.
So Jared, let's get your thoughts around Cell C. Are you hanging 10, waiting to see perhaps the next set of financials before dipping your fingers into that counter?
Yes, I mean, we don't have a significantly differentiated view to Victor, but maybe we'd frame it maybe a little differently. And I mean, we do like the management team that's been assembled at Cell C. We think they come with credibility from their previous employer, but we think that really needs to be balanced against the number of risks that we see in the investment case, and that's both in the short term and in the long term. And in the short term, I mean, we think that there's going to be increased competitive pressures from the incumbents, MTN and Vodacom, and that'll probably impact both Cell C's MVNO growth and potentially its own retail offering. And in the medium term, I mean, this business seems like it's really been built on buying wholesale capacity from MTN at quite favorable rates. And those contracts have limited life. We think it's about 5 years. And we really don't know what happens after that. I mean, do those contracts go away, or do those contracts get renegotiated at lower economics for Cell C? So we think, given that that's a risk in the medium term, the management team really need to try and pivot their business away from MVNO growth towards other vectors of growth. And what that looks like, we aren't really sure. What the capex and the intangible intensity on that looks like, we aren't really sure. So yes, there is a lot of risk in the business case and in the investment case. But when we look at these kind of equities, we try to price it. And for us, we probably reassess our view once we have a greater visibility over these risks, number one. And number two, maybe when the dividend yield approaches early double digits, that's when we'll start to reassess our view on the stock. So to sum up, probably one for us just to watch from the sidelines for now.
And that was actually going to be my next question. Where then do they pivot to when it comes to, you know, their next phase of growth? You look at the local market where, trying to grab onto a market share when it comes to that prepaid market, really quite difficult, with Telkom the only one showing a bit of growth, MTN, Vodacom also struggling. Cell C also doesn't have geographic diversification like the likes of a Vodacom or MTN. So it'll be very interesting to watch and see what comes out of Cell C. All right, we're moving over to Cell C's parent company, Blue. A question here coming through from a viewer: Optasia versus Blue. Are the two complementary or exclusive? Do I have to keep both in my portfolio, Jared?
Yeah, I think for us, Blue Label, I think going forward, the investment case is probably going to be predicated on about 4 items. I think one is the valuation of the Blue Label rump. In other words, what does that Blue Label valuation look like after you exclude the listed value in Cell C? And I think what we really need is a greater visibility on the earnings and the cash flow profile in that Blue Label rump. So that's the first point. The second is I'd like to see the financial statements simplified. And I'd hope that happens post the Cell C listing, because there were a number of restructurings in order to enable Cell C to list. The third point is on capital allocation. Yes, there is a windfall that will be directed towards Blue Label. It's probably not as big as Blue Label would have hoped for, but the question is, what happens to that cash? Is it purely just used to repay debt? Are there some acquisitions that happen on the Blue Label side? Is any of it returned to us in the form of cash returns? And the fourth point is we just like to see some more consistent messaging coming from the management team. So for us in the interim, we would prefer to play our telco exposure via the senior core telco players in the market, the likes of MTN, Vodacom, and Telkom, rather than Blue Label at this point in time.
All right.
Yeah, so that's our view on Blue Label.
Okay.
Do you want me to touch on Optasia or?
Victor, do you have anything to say about Optasia as a company you follow? It's been, catching a lot of viewers' interest before the listing even.
Yeah, I think Optasia is an interesting business. I think what's wonderful about it is that it has a asset-light business model, piggybacking on the distribution systems that have been set up by the telcos around the continent. We've got a strong management team in place and are really taking advantage of a gap in the market that's been left by traditional banks who've neglected to service that group of consumers. And it's a very wide footprint and it's high population penetration, very small loans. So they have really strong know-how. And the management is really outstanding in that they've managed to execute really well. If you look at some of those lending partnerships that Telco had with previous operators of lending businesses, as soon as Optasia came in and replaced those partners, they were able to improve significantly loans as well as credit risk management. So it's an exciting opportunity. One would have to be aware of the currency risk you're taking on, but I think it's an interesting business. It's very interesting fintech.
All right. Are you just excited about the healthcare industry, the private healthcare industry? That is a question coming through, putting up Life Healthcare and Netcare, both out with results this week. We did see a slight decline, a decline in profits in Life Healthcare, but this, of course, on the back of a once-off cost, but operationally doing well. Looking at Netcare, the digitization strategy really working in their favor.
Yeah, I think the hospitals are continuing to be in a challenging environment. One, volume growth, the number of lives that are insured by private medical aid companies is roughly stagnant. So they're really just benefiting from the aging population. You saw that Life Healthcare had about a 1% increase in their paid patient days, and their occupancy just came in slightly short of what they were targeting. They were targeting 70%. They came in about 30 basis points below that. So volume growth is expected to be modest. Second, the drawback of these hospitals in terms of their competitive positioning is that they have very, very limited pricing power. And the cap essentially has been put on their pricing ability by the power of the medical aids. So that's really one essential feature that we look for in businesses is does a business have power? And so the hospitals have been suffering from a lack thereof for most of the past decade. So that keeps us away from that group. They provide a great service to South Africans. However, their pricing is just not able to keep up with their cost base. We know that the cost of providing healthcare continues to increase at rates above inflation, but they don't seem to be getting increases in their rates from medical schemes that can allow them to pass on those cost increases.
All right, Jared, I'm going to give you a totally different question. I'm going to try to squeeze in two more questions before we move over to stock picks. Pan-African Resources really did well for me. This is from a viewer, of course, really did well for me. And I was wondering if I should keep these shares or whether there's more upside or sell in January after gold does its December price increase. Well, I believe it, even if it's not true. Are we likely going to see a gold rally even further at this point?
That's a fantastic question when it comes to gold.
Yeah.
Because what we always find is views are very polarized. You either love it, you hate it, and there's no in-betweens.
Yep.
But maybe if I was to give you a bit more color on your actual question, and I mean, we think that there is scope for further for the gold price to run further. I mean, what we've seen is central bank buying, underpinning the gold price, not just from 2022, but it's actually happened about almost 10 years ago. It's just that it's been expedited from 2022, particularly countries from the East. But also we are potentially going into further rate cuts by the Fed. It looks like there's about an 80% pricing by the market of a Fed rate cut in December, as well as maybe 3 more rate cuts being priced into 2026. And if you look at the last 25 years of history, typically this coincides really well with an upcycle in the gold price. And then lastly, it does look like there's a broadening of the participation in gold, particularly as an asset class. And I mean, if you think about a typical portfolio, 60% equity, 40% bonds, now it looks more like 60% equity, 30% bonds, and 10% alternatives, where gold is now featuring. So to our mind, we think that there is potential for the gold price to continue running. And naturally, what does that mean for Pan-African resources? Well, the interesting thing about Pan-African resources is it's a gold miner that has very few gold mines.
Yes.
So it sounds like a bit of an oxymoron, but that in itself is what kind of differentiates Pan-African resources, because a reasonable chunk of its production is actually from surface assets, which aren't traditional mines. That implies lower risk to that production. And I think it's one of the few gold counters that provides that kind of production mix. On top of that, most of that production is actually unhedged going into next year. So that means a lot of free cash flow generation is expected from the counter. And if the gold price does tend to run next year like we expect it to, then you will find that Pan-African resources will outperform from a free cash flow generation perspective.
All right.
So we do like the name.
Okay. So let's get to stock picks. I can't even get into any of the other questions. So I'm going to go with you then, Victor. Where are you seeing value at the moment?
At the moment, I like Pepkor. You would have seen that this week they reported a really strong set of results. Pepkor is really well positioned in South Africa. They've got a great scale advantage. Their footprint is about 6,000 stores strong. And their positioning is appropriate for the consumer in South Africa today. They play in the discount and value retailing segment of the market. They dominate in kids' clothing, children's clothing, schoolwear, as well as selling prepaid cell phone handsets. They do have opportunities to expand beyond that to adult wear. We see they've rolled out the new chain for women, Ayana. Then the exciting part of their business is their fintech and credit business. A lot of opportunity there. We saw revenue grew there by 31%. And the exciting part is that fintech revenue comes at higher margins than their existing clothing and furniture business. So great opportunity there. Outstanding management. They've got a business in Brazil as well that has some good growth prospects. It's trading on a fair multiple, and so there's in our books it's got significant upside still.
All right, let's get to your pick then, Jared. Where are you seeing value at the moment?
I'm going to stick with the gold sector. We like Harmony Gold. We think that the equity has lagged its peers in South Africa quite materially year to date. That's a function of the market expecting higher capex from some of the projects that it's going to start imminently. And on top of that, it also had a less appealing dividend payout and therefore dividend yield. But we think all of that's in the past now. Looking forward, we've spoken about the gold commodity. So we like gold. We like the increasing copper exposure of the portfolio. That is a future-facing metal with constructive supply-demand fundamentals over the medium term. And in the near term, if we get these rate cuts that we're talking about from the Fed, you'll typically find that there's a macro underpin to the copper price. Third point, we think that the dividend policy will be revised next year, and that will be a catalyst for the stock. And very lastly, if we overlay the valuation, we don't think that the 30 to 40% discount to its South African peers is warranted, given the better jurisdictional risk mix. The funding profile is going to change, so that means increasing economic value added for the company. And we think that the capex cycle that they're going on to is relatively low risk.
All right, let's leave it there, gents. Thanks so much for your time this evening. That's all for Stockwatch today. Thanks to my guests, Jared Hoover from All Weather Capital and Victor Seanie from Benguela Global Fund Managers. Up next, the close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.